commitment to is a time commitment. So
Got
to be a material participant in real estate, again, real estate has its own carve out for this definition because many people try to take advantage of this. To be frank,
no way.
yeah,
No way people take advantage of that. Yeah.
Well, when you're in TurboTax and you click the professional real estate, all of a sudden you owe $0. You're like, well, I'm a pro. Look at me, I'm fine. So they don't really.
The IRS loves that. Yeah.
It's as simple as that. Just hit that button and now it's like, oh, now I owe no taxes. So people accidentally or purposely take advantage of that all the time.
Welcome to Planning Reimagined, a podcast from the planning experts at Robin Glen and RX Investment Partners for wealthy families and successful business owners.
Hi, I'm Celeste Moya. Welcome to the first episode of Planning Reimagined, a podcast brought to you by the experts at Robin Glen, focused on wealthy families and successful business owners. Our goal with this podcast is to provide actionable insight that you can incorporate into your personal and business planning. We'll also be demystifying some of that information that's out there in the universe of the internet and have some fun doing it as well. Each of our episodes is going to include our very own planning experts, along with guests who will go over topics such as estate, tax, business, income, and financial planning. And of course, we're going to be covering life insurance planning as well, because that's one of our core areas of expertise. So please make sure to subscribe so you don't miss any future episodes of Planning Reimagined. Over our first few episodes of Planning Reimagined, we're going to be talking about real estate as a tool for building wealth. We're specifically going to focus on that intersection between real estate ownership and taxes. So we'll share information over optimizing returns, maximizing deductions, different ownership structures, and just in general, what are the best strategies when you're building that real estate portfolio. And then we're also going to debunk some information that's out there from a TikToker that most of you may know or may have heard of, and just share some of the information that he's sharing and maybe our different view on it. So make sure you stick around to the end to hear that as well. So today we're joined by our very own Robin Glen's Kris Stegall and Mike Mazzone, who have so many designations after their name that you can just read the screen to see what all those designations are. But they're very much qualified and have a lot of expertise in the tax planning space. So let's get into our first topic. So let's talk about taxes and ownership structures, which I know is areas that you frequently have conversations with our clients. So first, Mike, I guess if you want to kick us off and talk about real estate taxes, the various types of real estate taxes.
Yeah, sure. So no, this is a very pertinent topic to a lot of our clients. Business owners, by way of their business, typically hold real estate underneath their business structures. And upon exit, a lot of families who sell a business, they allocate a good portion of their wealth to real estate holdings. So we get a lot of inbound inquiries regarding, what's the right way to hold this real estate? What's the best way to maximize income deductions? How do I exit from this real estate in an income tax efficient manner? So it's a very relevant topic for us, and we talk about this stuff a lot. And to your point, real estate mainly has a very strong lobby, and they have it's a fantastic investment for income tax purposes, right? You have pretty much the ability to depreciate that asset, sometimes accelerated, in a manner that you're still having a great cash flow income producing property that should be also appreciating in value. However, you have this ability to depreciate against the income tax so that you're not paying income tax on it. So from that perspective, it's a fantastic investment, which, that's not news to anyone, but that's kind of the impetus of why businesses, family offices, et cetera, allocate a good portion of their wealth towards real estate. Kris, you agree on that?
Yeah, that makes total sense. A lot of the clients we work with have significant real estate portfolios, and then sure, they're trying to find different ways to help them mitigate some of those income taxes, both capital and in some cases, I guess, ordinary, as well as is key for them. And then to your point, down the road, what are they going to do to sort of offload that real estate portfolio as well? A lot of the clients we work with don't necessarily want to keep that portfolio forever. So some of that comes into to long-term planning as well. One of the things that I like to do just in my general practice, like anything that I'm doing, I always find like correlations between two different things to try to draw a picture. And one of the things that I thought was kind of interesting when I was looking at this topic was, and we don't have to spend a whole bunch of time talking about this because it's not that interesting, I think, to the overall podcast. But it's interesting to us. And that's property taxes. So again, we don't really spend a whole lot of time talking about property taxes. It's just one of those things that we have. But I did think that it was interesting that Illinois has the highest property tax, and that's where you live.
Oh, absolutely.
Right. And then you have New Hampshire, another member of our team. That's the second highest on the list. Texas, that's where you're at, Celeste. That's they're ranked 46, so they got a very high one. As well, I'm in Pennsylvania at 41. So for some reason, us folks at Robin Glen apparently like the highest property taxes.
Yeah,
so
absolutely.
So anyway, so yeah, I mean, but in thinking about taxes and how to mitigate those. So when people are looking at real estate, and Mike, this is kind of a question for you. When people are looking at real estate, both on the income when they're trying to generate income from it, sort of the difference between like what becomes ordinary, what becomes capital gain. Can you just kind of talk about those two things a little bit, maybe from like whether when they're getting rentals or when they're trying to actually sell a property?
Yeah, no, absolutely. So like I said before, the real estate lobby is pretty strong, and they have great tax attributes for real estate investing, but it does come with a lot of, I don't want to say pitfalls, but it's a different class of asset than investing in the stock market, investing in the bond market. So there's two different types of tax that can be thrown off typically from real estate. It would be an ordinary income event. Like I said, if you're renting, if you buy a building and you're renting it, that would be ordinary income to the owner. And then ultimately, when you go to sell that was when you trigger your capital gain. So when we think about planning around that, it's typically the life cycle is let's minimize tax while holding, and then let's think of some good exit strategies so that we're not paying a ton of capital gains when we eventually want to liquidate because we want to cash in or our children just don't want to manage our real estate portfolio or whatever that looks like. So there's definitely there's always competing interests, and then you throw a state tax on top of that, which we could probably talk about later, but there's always a lot of competing interests around this space. So although it's a great asset, you do have to do a lot of pre-planning to make sure that you're utilizing the tax code up to your the best use.
And that's a really important point, because I think in so much of what we do, our clients are not thinking about the exit from it. And there's so much pre-planning that can be done in general in planning that we do that can save them so many taxes, so many headaches along the way. And so if we can talk a little bit about ownership structures, we have so many clients that have large real estate portfolios. And then when estate taxes are due, it is a mess, right? Because of how liquidating that might impact their overall portfolio or their overall assets. So can you talk a little bit, either one of you, whoever wants to take this, the impact of those ownership structures? Like, what are some of those examples, pros and cons, and maybe some of the examples that you've seen with families that have done it properly and then maybe not done it so great?
When people get into real estate, especially initially, I think a lot of times they're just owning it outright, right? Which is kind of a mistake. I mean, you own it outright, it's subject to creditors, all these other things. Asset protection maybe isn't what it needs to be. And so the second level of that, which I think where people are more sophisticated, is starting to put into LLCs, right? So it's a pass-through entity, doesn't really change the income tax attributes of owning it, but it does add that additional layer of asset protection so that, if something happens and they get sued, maybe that's a little bit separate. So and then you have more sort of exotic, not really exotic, but maybe you could touch on, like, do people actually own things in S Corps and C Corps on the real estate side? Is that a thing?
I'm an advocate of, unless there's a very compelling reason to own it in a C Corp, it's almost always owned in an LLC taxes partnership. There's a lot more tax nerdy things that I won't get into here, but the partnership typically gives you the best partnership for tax purposes. So limited liability company taxes partnership typically gives you the most flexibility in future planning, when you pass away, as you transfer those type of items.
Makes total sense. And a lot of those are really geared towards this, again, asset protection, because again, the income tax attribution is going to be very similar. But from an estate tax perspective, that can be key, especially in the partnership, because then you can kind of move interests around and try to help protect against estate taxes, right? Yeah.
So that's some of the flexibility I was, kind of speaking of. If you own the property in a limited liability company, you now have an easier mechanism to gift a portion of that real estate to various, estate planning techniques, such as, gift trusts, dynasty trusts, those type of items, to get it out of your taxable estate. So once you have that in that LLC, you have the ultimate flexibility of really splitting up that inheritance and minimizing your estate tax without having, various trusts or individuals own the real estate directly.
Got it. Makes total sense. So taking a step back away from estate taxes and maybe going back to income taxes for a second. So you mentioned a couple of things that folks do to help push down that income tax liability. So things like depreciation and things like that. Can you give a few more examples of how people sort of minimize the income tax, we'll call it drag, annual and then at exit?
Yeah, no, absolutely. So, a lot of the clients that we have coming to us are, like I said, they probably were passive investors at one time. Maybe their business owned a few parcels of land where they operated their business. As they had money coming off of that business, they decided to invest in multi-unit buildings, in their area across the nation. Very passive in nature, right? They're, it's just part of their portfolio. And then upon sale of their business or, sometime between owning 0 properties and 20 properties, they found themselves more focused on being a real estate investor than they were running their business, right? Maybe they took a step back on their business and now they're really real estate focused. So, our first, discussion is, is this really a passive activity for you? Is it just, a part of your passive income portfolio? Or are you able to possibly qualify for what's known as a real estate professional for income tax? And once you qualify as a real estate professional, any loss, when we talk about that depreciation or any other expenses that you have, any loss thrown off by that real estate can actually go against your other business income. So it's hugely impactful for someone who, like I said, owns a business. It's cranking, it's printing money, but it's pretty much, maybe they hired a CFO or CIO to run it. It's kind of a set it and forget it for these families, but they're still getting a tremendous amount of ordinary taxable income from that. The ability to offset that with real estate losses is hugely impactful because, again, those real estate losses are by and large paper losses because of the depreciation, the accelerated depreciation.
And so becoming a real estate professional, like what are, I guess, the measurements for that, the guidelines, or just generally, is it a certain amount, a dollar amount that they're looking for, or a certain amount of assets?
So it's a commitment it's a time commitment. So to be a material participant in the real estate, again, real estate has its own carve out for this definition because many people try to take advantage of this, to be frank.
No way. No way people take advantage of that. Yeah.
Well, when you're in TurboTax and you click the professional real estate, all of a sudden you owe $0. You're like, well, I'm a pro. Look at me, I'm fine. So they don't really
the IRS loves that. Yeah.
It's as simple as that. Just hit that button and now it's like, oh, now I owe no taxes. So people accidentally or purposely take advantage of that all the time. But it's typically, there's 4 or 5 rules that you can qualify. The largest 2 hurdles are 750 hours of committed time to real estate. And that doesn't necessarily mean, you're there hammering and nailing, but like, you're looking for real estate, you're going through the portfolio, you're visiting, you're, coordinating repairs, those type of items. And then the second hurdle is at more than half of your allocated business time is towards real estate. Okay. So that's why I said for that business owner who's kind of peeled back from the day-to-day of that business, and now they're focused primarily on their portfolio, a lot of times they don't necessarily tell their tax guy, like, hey, by the way, I'm not really doing this, I'm doing this, right? He just sent the paper in, they're passive real estate guys like they always have been for the last 20 years. But a lot of times, as they're phasing out of their business, there is an opportunity to either, them personally become real estate professionals, or alternatively, what we see a lot is the spouse of the business owner might also, start allocating a lot of time to the real estate because of those great tax benefits.
Yeah, absolutely. That makes sense. So the word management company comes up a lot, so what does that really mean? If you can share with our viewers, like, what does that mean? What are the considerations, when to use it?
Yeah, no, absolutely. So, when you kind of follow that thread of, you're a real estate professional now, the next obvious jump is, okay, let's really institutionalize our management and ownership, purchasing, selling of real estate and house it in a management company. So what that does for the taxpayer is, now that they have non-passive income, they can allocate, essentially take money from the real estate portfolio and pay a management fee to a company that they're running. And that would be tax deductible to the real estate. And again, now that it's non-passive, that will flow up their 1040 and go against their business income, which is super impactful for them. But then, the next obvious question is, well, now we just have a bunch of taxable income in the management company. But what we typically try to, install in the management company are certain income tax deferral mechanisms such as 401ks, cash defined pension plans, split dollar, which we'll probably talk on a little bit today or at a different date, so that they are really, maximizing the current income tax benefit of that deduction, deferring the tax received by the management company, and really establishing not only a cash accumulation vehicle for them in the future, but what I consider a good, barbell as far as investment allocation away from real estate. I've never been lucky enough to tell a real estate professional or someone who invests heavily in real estate that they should allocate away from real estate. But, if you do find one of those people, this is a really, really good idea or, strong idea to fund more middle of the fairway, like I said, opposite, different diversification from real estate and different risk allocations while being very income tax advantaged.
Yeah, and diversification is generally recommended across any type of planning that you do, although there are some experts out there that recommend against it. We'll talk about that later. But it's just an important way of ensuring you're protecting your assets, right? If something goes wrong one way, at least you have other options to fall back on.
That's absolutely it. And, people who've lived through 08.
Yeah. Oh, absolutely.
Right? So it's always like the younger generation is like, well, every time I buy another piece of real estate, I make 30% on it. Why would I allocate to a defined, pension financial plan? People who kind of been through it and maybe learn from their mistakes the first time, they're a little more open to those conversations of, hey, we're going to get a great income tax deduction up front, and we're putting a bunch of money away from you in an asset protected vehicle that if the real estate market crashes, this will be there for you still.
Yeah, it's super important.
Yeah, I think that with management company as well, I mean, you hit on some of the sort of the extra benefits that you can have inside those entities. I know health plans comes up quite a bit with our clients, especially when they're stepping away from their day-to-day job. They've decided to take the plunge. They're really just going to focus on their real estate holdings, set up the management company as well. Healthcare often comes up. So a lot of times those corporations are also used to create those plans. And I think another interesting thing about the management companies is it's a wonderful way to start incorporating family into the real estate enterprise as well, because now you really have this true mechanism to, bring your children in, show them the ropes, show them how it works in a real corporate setting as opposed to just something that it seems like it's done on the side.
Yeah, those are two awesome points. The amount of times where we have a client sell their business for, 50, 100, $500 million, and they're introduced to us, and I'm excited to show them all these cool things we could do. And they go, oh, wow, I could do, we get a meet nerd out with functional circles.
All the charts, all the graphs.
Oh, yeah. They just freak out on Excel. And they go, and they're from, and we get out a call, and they're like, we don't know how to get health insurance. And it's like, it's a shocking amount. I'm like, I don't understand. You have literally $100 million sitting in your bank. It's like, we have no good way to get health insurance. So to that point, all the benefits that they had at their businesses, they took for granted. 401ks, but health insurance, other fringe benefits, medical reimbursement plans, those type of things. When they sold the company, just kind of went away. So this is, it's a great, maybe not ancillary part of it because this is their primary focus of it. It's like, that's a great point also. And then once you do have that institutional, centralized location of the management company, it's a great opportunity to bring your children in to determine if it's of interest for them or not, right? It's we have a lot of
they're
clients.
Children doesn't mean they're good at it.
Absolutely assume that when I'm done doing this, so and so will do this. Then you have a talk with the kids like, I hate that stuff. I don't want to touch real estate. Right. So it's a good way to bring them in, get them kind of used to how the day-to-day operations work and whether or not it's for them.
Just talking about families, families are at the core of what we do day in and day out. And every family is unique and different. Do you have some examples of some families, whether good or bad, that have, incorporated real estate into their planning and have either done the proper planning to have those exits or not? Any example that you have of that?
Yeah. So, I've been kind of hinting around a lot of what I consider success stories around this type of planning. We have a client that we're currently working with who's, like I said, his business was kind of going here, and all of a sudden, hockey stick trajectory, which is most people that come to us, right? And they be like, oh yeah, I was doing, 3 million, now I'm doing 300 million. It's like, oh, so what do I do now?
Right.
And with that kind of came, buying piece of real estate here, buying piece of real estate here, but now I own a, real estate empire. How do I be more thoughtful about that ownership? And, it was, this client in particular was very, open, like, hey, probably did this wrong at the front end just because I'm running a business. We're buying property. We're building things. He's like kind of 100 miles an hour.
Yeah.
He's like, I know I've done this wrong. Help us reconstruct this. And, he was very open to us kind of being in the middle with his CPA, with his, real estate attorney, with his estate planning attorney to say, okay, here are some of the ideas which you could do. And a lot of them we've kind of mentioned already. It's really the isolation of the real estate into the LLC, renting from that. So we have two different, ownerships. So a lot of real estate isn't appreciating in an S Corp or a C Corp or something along those lines. So it's a lot of that. And then, as he's thinking about selling his business, we're also currently setting up a management company, which might be more passive in nature now because he's still operating on top of this real estate. But once he sells business and he's a pure real estate guy, that's when we could really turn on the accelerators and really give him some great income tax benefits. So that's one that we're currently working on now. And it's a fantastic result for him. He's very appreciative because as much as we nerd out about estate tax, like when you save someone income tax on their 1040 the next year, they become a lot more grateful.
They're alive.
Yes. Yeah. They might get to see the benefit of it. They get really excited about it. So yeah, I think that's a great success story as far as just, it wasn't a massive overhaul of what he's trying to do day to day. It was just kind of working around the edges, what he already had. And the income tax saving was tremendous. And when it's an annual income tax saving, like that compounds annually, it's an awesome benefit for him and his family.
A great takeaway from that is that even if you maybe didn't do it right initially, you can fix it, right? It's not necessarily something that you're completely lost, forget it, you're done, you're going to lose everything, So for our viewers to understand too, that it's possible to make mistakes as you're growing as a business owner and then go back and fix it as it makes sense and evolve, because really that's a problem that we see with a lot of our clients is that they do planning and they're like, I'm done. And it's something that evolves over time based on their situation. So being able to change it is possible. So that's great.
Yeah, Kris. The worst client we have is the one that says, I've already done my structural planning. I've already done my estate planning. I'm like, well, maybe I have, but you're worth so much and things are moving all the time. Like it's an ongoing process for you. Even if you had a great structure 3 years ago, it's probably not the right one for you now. So those type of open-minded clients are the ones that we really like.
Laws change, presidents change, everything changes. And so they have to be able to evolve. Kris, did you have another example?
No, I was just going to say, I think a lot of the stuff that we look at initially is really just sort of trying to help them organize things. So a lot of times they still own things in their name. So it's like, okay, well, we need to break this apart. We need to get them LLCs, maybe do a series or whatever makes sense. And then we have a lot of clients who, bought that wonderful vacation home in Puerto Rico or France or something along those lines. You're like, well, that has a whole different set of implications that they probably had no idea or understood. So a lot of it is just, again, just sort of help them understand exactly what they've got, how to reorganize it, how to make it, protected from, asset protection, and then start looking at income taxes. That's like a very common theme for a lot of the clients we work with.
So before we move on to our next topic of conversation, I think it's important, Kris, maybe we explain the unicorn in the room, literally, and why we have a unicorn here with us today.
Oh yeah, sure. I would love to. So sometimes, as we do, we have to get up and we have to travel, in the U.S. and abroad. And my kids miss me a lot whenever I'm not at home. So on one of my recent trips, my oldest daughter was really upset that I was leaving. We had alligator tears. It was really, it was touching. And then she ran to her bedroom and said, wait, you can't leave yet. And so I didn't know what was coming. So she ran to her bedroom and came back with Starry. So Starry now travels with me everywhere I go, just as a reminder of how important it is to stay in touch with your kids, even if you're not sitting there at home. So Starry is going to be hanging out with me for a long time now when I'm traveling.
Star is the unofficial Robin Glen mascot, beyond the Robin that we have too.
I should also point out, just because if my daughter ever sees this, she's going to be upset that it was called it a unicorn. Starry is very much an alicorn.
Oh, so alicorn. Okay.
I can't have her correct.
I apologize, Cora. I apologize. So all of this has been just so helpful and informative as far as real estate and taxes and investing, 1031s, everything we've talked about. But as we're going to do with every episode that we have, we want to talk about something that's out there on the internet that is maybe not 100% true, help our audience kind of debunk some of the information they get. Unfortunately, there's a lot of great information on the internet, and there's a lot of bad stuff too. So specifically today, we're going to talk about Grant Cardone. He is seemingly everywhere on the internet. He's very popular, so we'll give him that. He's done a great job of, building his brand, and he promises his viewers or his followers riches through real estate. but he has a very different stance than what we've talked about today. So we talked a lot about diversification, and he has different views on that. So we can talk about some of the things that he shares with his followers and maybe talk about why we would steer them in a different direction. So first, one of the things that Grant Cardone says to his followers is rich people should put all their eggs in one basket and then protect that basket. So, Mike, Kris, how do we feel about that?
I'm just kind of visualizing.
And actually, I forgot to mention one thing. This is Kris's term. This is the shiny object whack-a-mole segment. Because it's exactly what it is sometimes. It's a shiny object that's been represented to them, but maybe not 100% accurate. So we can talk about that first one, putting all your eggs in one basket, essentially.
Yeah, I'm just like envisioning like real estate investors, trying to put everything into an Easter egg basket, running around in the yard like, no, this is mine. Don't touch it. Don't touch it. I think a lot of these things start off where there's like a hint of truth, or like something that's a hint that makes sense in whatever, the TikTokers or whatever are putting out there. And then he just goes wildly crazy, or they just take it way too far. And I think this is probably one of those instances. Like it's good to invest in real estate, right? It is a market that continually goes up. If you look through the history of the US and the world, like it's one of those assets that it does what it's supposed to do. It appreciates, it creates income, it definitely generates wealth. But I think to just do real estate solely, I don't know. Most of the families we work with are trying to always find ways to diversify. Warren Buffett certainly diversify. So I don't know.
And he seems to know what he's doing.
Yeah, I would guess that. Yeah.
No, I think that's the more accurate statement, but that's not going to grab headlines as opposed to buy all real estate all the time and then somehow protect that whole industry and the economy somehow with your real estate shield or whatever you're running around to protect that egg. But no, to your point, a younger Mike Mazzone graduated college a little bit, ready to take on the world, a lot more hair, was ready to rock and roll. And this was pre-meltdown. So I had the ability to buy a substantial, way beyond my means piece of real estate with, a pay stub from my first job out of college. So I'm a huge proponent of buying real estate. I probably, added to the meltdown in 2008, but, it was right. The size were great. So I'm a huge proponent of it. There's very few chances where someone can get an appreciating asset, borrow a bunch of money from the bank.
As long as you're breathing.
As long as you got a pulse, you can get a bunch of money in the bank at the time. But that being said, we've seen ebbs and flows, and you need to diversify your risk away from that. I don't know. I mean, maybe he could expand on how you protect a whole market share, but in that case, like it's a great asset. It's a great income tax asset we just talked about, but the inability to control what you can control and another, huge crushing crash of the market, you're going to want to have assets protected first and foremost. We'll talk about what we have talked about, protecting that real estate asset and your other assets. But more importantly, finding a barbell to your real estate assets that are also asset protected and insulated from a real estate crash.
Absolutely. I mean, I think we talk about diversification, not just us, everybody in there, for the most part, everybody in the financial planning space talks about diversification for that exact reason. I mean, you can't predict the future, what's going to happen. And there's so much change happening all the time. And not having that, you're just setting yourself up for exposure. Yeah, I mean, at the end of the day. So the second thing, another thing he shares with his followers is don't buy a house, so essentially rent, but invest that money in real estate.
It seems kind of backwards, right?
Yeah, so that's another very counterintuitive one to me, because obviously if you're bullish on the real estate market, if you put all our eggs in one basket, why would I pay someone else for the right to stay in that piece of real estate if I can afford to own it, have the great income tax attributes that come with home personal ownership,
right?
As well as, ride that appreciation up and down and borrow the same way that I assume he's suggesting when you're buying rental units and those type of items as well.
Yeah, it just seems like something somebody who owns a bunch of rental properties would want people to do.
Yeah.
You just pay me the rent. Let me go ahead and build up my portfolio that I clearly own. You just keep paying me. Don't worry about owning yourself. Just seems counterintuitive. Yeah.
And I don't know about other parts of the world, but here, Dallas, Texas, the rent is outrageous, right? Rents are outrageous. It's almost more expensive than owning a home at points. So that's why, to me as well, it seems counterintuitive. So lastly, we have on here, don't invest in smaller unit properties. Only invest in mega properties with hundreds of units.
Like shopping malls? No, it's an example though, right? Shopping malls, invest in shopping malls.
Although
It's not a housing.
go to the
unit,
shopping mall anymore.
but nobody goes anymore. But that's kind of the point. Like again, you don't know the ebb and flow of what market's going to do year in year out. I mean, again, going to that idea of diversification, it's important to diversify in other asset classes. You're going to have more liquidity than real estate, but you probably shouldn't just go strictly into, high rises and, that kind of stuff.
I think he takes a portion of your money and then he puts it into these mega properties, but I'm thinking you have no control over that, So maybe, and what if you don't have the assets to be able to go buy mega properties and you need to start off small? How many business owners do we not know and have worked with that aren't a Rich's story? They really started from the bottom, had a little money, bought a property, and then rolled it up into other options and opportunities. So
absolutely. If you have the means to, get into a certain syndicate where you have that type of asset, the Class A asset in, Manhattan, well, fantastic. But how could you say that, but also go rent property, somewhere else? Those are kind of counterintuitive in my mind. Mm-hmm. But, we talked a lot about the control factor, right? If you are going into a fund or something where you're paying a ton of management fees, and secondarily, you have no control over liquidity or what's happening on that real estate. And it's, again, you get a lot of shock value making blank statements. Like there's a right time and right place, right asset allocation to a larger portfolio of, larger units. But by and large, those investors who are thoughtful about buying, B and C class real estate and 3 and 4 flats in, up and coming markets, they'd probably beg to differ versus giving someone your money and just, crossing your fingers, hoping that they're doing really well in a very high end market.
Absolutely. I mean, I guess in summary, if you're hearing something out there from somebody, it sounds too good to be true, first of all. And it's so pointed in one direction, it's generally not the best piece of advice. Maybe do a little bit more research on why is that their stance? What's the benefit to them at the end of the day? That's
exactly it. It's this advice, or is this advertising, right?
Right, absolutely.
What is this person getting out of it? And if he happens to own a huge real estate, a REIT or real estate thing, and say, hey, why don't you rent and take all that access and give me the cash?
Yeah.
There's probably, it's not unbiased.
Right, yeah, exactly, yes. Maybe some less biased advice. I will say Grant Cardone has some incredible quotes out there. So if you guys haven't read some of his quotes online, they're very motivational.
At the time.
So if nothing else, you can be motivated by his quotes.
Nice.
Well, thank you all so much. I have the pleasure of working with you all every day and being able to pick your brains and, see all this expertise and knowledge that you have. But I'm so fortunate now to be able to share it with our viewers, with our audience, and share all of this important real estate information. As we mentioned at the beginning, so many of our clients have real estate portfolios. It's just such a common thing, the American dream, to be able to build upon it. Right. And so it's so great to have this foundation of information, and we're going to keep expanding on it in future episodes, talk about the other parts of planning when it comes to real estate, succession planning, transferring it to your heirs if you want to, or other ways that we need to plan for real estate as well. So for our audience, if you want to reach out to us, if you have more questions, if you want to learn about the planning that we do, you can contact us via email at hello@robinglen.com, or you can go to our scheduling link, which is in the show notes, and schedule some time with us as well. So thank you all very much. This has been awesome.
Yeah, a lot of fun.
Yeah.
Great first episode.
This is great.
Thank you.
Yeah, thank you. Yep.
Thanks for listening. Don't forget to like and subscribe. And please be sure to follow on your favorite podcast player. To connect with us, you can email us at hello@robinglen.com or schedule some time with us via the link in the show notes. You can also find us on Instagram and TikTok at Hello Robin Glen.